well, direction and mood across these markets, Chinese stocks, otherwise. Sean, a pleasure to have you on the show. We talked Alibaba. Here's another one, WuXi Biologics. There's so many reasons to remain, I guess, bearish on this market. What do you think opens up this cage so, this market can finally stretch? We've been waiting for about 12 months now, Sean.
Absolutely right, David. I think what unleashes the market is confidence in the consumer in China. I think that, we still have a lot of issues with the internet companies, as you've just been talking about. But what's been persistent over the last 3 months has been a weak consumer. And once that gets going, I think that, the market will pick up with it. And, it's really difficult. I mean, you look at the PMIs that have just come out recently. The consumer, it's hard to know whether it's the property issues that are, keeping the consumer to stopping them spending and saving more, or it's, the employment issues, or it's lockdown. It's difficult, but we need to see the consumer pick up. And then I think China will start to perform pretty well against the rest of the world.
When?
Well, I think we will not have any better news in the next month. I think that things will be, with the Olympics going on, and then people will start to look at the comparisons of Chinese New Year for February. Then I think in March we'll have the MPC, we'll have the 2 sessions, and then we'll get more guidance from the government about, more stimulus coming in, and what's going to be happening with lockdown, either internally or, externally with Hong Kong. And I think that's really important. If you look at some of the activities, I mean, you've got travel down 44% from 2019 internally. You've got cinemas, you've got service industries really sort of suffering in China. I mean, the only good news was Hainan duty free, which was up on year. So it's I think people could be disappointed with the strength of the consumer over the next month, but I think there'll be a turning point in end of the first quarter, beginning of the second quarter, where people start to look through it and start to see more positive news. And maybe it's earnings that does it. We're still seeing disappointment in earnings, unlike what we're getting in the US. Maybe we need to see either stocks reacting okay to bad earnings, or starting to see guidance being lifted upwards.
And Sean, I'm just wondering, last year the trend was still about U.S. outperformance, optimism on Europe, still a little bit more cautious when it comes to Asia. Is that likely going to reverse this trend? You mentioned about China maybe outperforming the rest of the world, but do you see that actually happening quite quickly here this year? Or we're going to have to wait until to see how Omicron plays out in this region?
Yeah, I think we have to wait to later parts of the year for China outperformance. I mean, we made a pretty clear call, towards the fourth quarter going, and then continuing into this year, that one should be more balanced with one's portfolios. That it's not just about the US, that we should be adding Europe, and we should be balanced across regions. But we haven't been brave enough to make the call to go overweight, Asia, China, emerging markets. We think it's still too early. And within sectors, we've changed our positioning at the end of last year, as you know, where we've been coming out more gone neutral tech, been worried about tech that doesn't have any earnings, and been more into industrials and financials, and energy and commodities. And that call is working out quite well. But the risk here probably is Europe and what will happen with the gas prices, with the Ukraine Russian situation, and then the risk in Asia of underperformance, and even in Japan, Yvonne, is that we still continue to get lockdowns. I mean, we got very positive at Japan at the end of last year. That trade worked quite well for a while, and now it's been a bit dampened because COVID restrictions are coming back again.
So if I'm still, seeing that sort of tightening impact on stocks and bonds, I'm just wondering, is commodities still the asset class that you can maybe park your money at and perhaps ride out this volatility?
Yeah, certainly over the next 2 months, while the market's still adjusting for change of monetary policy globally. I mean, obviously we've had a lot of talk about the Fed, and I think now in the next 12 months it's 5.5 hikes that are expected. We've had quite a big shift in the last 6 weeks with the ECB. With the market's expecting 3 hikes over the next year, quite small ones, and then we've seen other emerging markets hike quite aggressively. And you take the case in Brazil, they've hiked nearly sort of 800 basis points, and we all know that China is going to stimulate more, but at the moment it's all really about tightening. And I think it's not just about the level of interest rates or where the 10-year is. I think it's going to be about the balance sheet and what liquidity comes out, because a lot of markets, even in Asia, have been driven by retail investors. They've been driven by excess liquidity, and once that liquidity starts to tighten, that could have a dampener on assets. And within that environment, you want to be in commodities, you want to be in real assets, in property. And also you want to be diversified.